right? All we're trying to do is get probabilities in our favor to try and roughly assess. But here's what's simple, is if you look at a chart of the ISM over the last 50 years, it goes up and down in cycles. The economic cycle, we all hear that term. What it means is kind of, that if it's rolling over, it's likely to go all the way to recession. It doesn't always happen, but your probabilities are high. And once you're in recession, it tends to start picking up again, and that gives you the green light to maybe buy some of these things. So in a very simple terms, you're looking, the 50 line in the ISM is roughly where it goes to contraction or expansion. If it's coming down and going through 50, you start to worry about recession. So currently, while we're doing this, I think the ISM is somewhere around 52 and on its way down. So we're starting to think, oh, there's probably a recession coming, almost immediately to recession, and pretty sharp. And I think a lot of people are sensing that is happening. You're hearing it from companies. You're hearing it from a lot of people to say, yeah, looks like we're going to recession. So the forward-looking stuff suggests we're about to go into a severe recession. So now you need to figure out, well, what are asset prices pricing in already? Because you can't trade on today's news. You need to trade on tomorrow's news. And really speaking, you need to trade 6 months out news. And so where are we? So if I look at the year-on-year rate of change that I talked about, if I look at the S&P 500, it's already pricing in about 42 in the ISM, so a full recession below that 47 level. Could it go a bit further lower? Yes, because my forward-looking indicators suggest the ISM could get down to 40 or so, maybe a bit lower. But we're kind of in the right zone to say, actually, a lot's been priced in. Could there be one leg lower? Maybe. But that means that as an investor, your spidey sense should be up saying, hey, is the opportunity coming here to buy when everybody else is fearful? So again, my forward-looking indicators suggest that the economy picks up maybe in the first quarter of next year. So in which case the markets, because you want to be ready when nobody else is, when everybody's being forced to throw all their trades out and stop themselves out from losing money, you want to be able to buy. So you kind of want to have cash ready, and then you want to see what the economy does, and then start to see, hey, are bond yields coming down? Are the Federal Reserve going to stop raising rates? Those are kind of signals that the future economy in a year's time is not likely to be as bad as what we're seeing coming in the next 3 to 6 months. And it's that transition that becomes very interesting for investors. So, basically, if you're young, you should be risk seeking. If you're old, you should be risk avoiding. It's as simple as that. So if you are young, you should be looking at, okay, how do I take advantage of the sell-off in crypto and the sell-off in stock markets and technology stocks? Because those are the things that will drive returns over the next 10 or 20 years. But if you're older and you're retiring, you want to stay in cash for longer. You don't want to take as much risk because you don't have an income. So your grandparents don't have an income anymore. So it's just their pension. So they need to be careful, very careful with their pension. Their nest egg has to be protected at all costs. But generally speaking, I'm not picking up, oh my God, we've got a debt crisis coming or something really bad. So I think it is different. And so a lot of people are expecting the next leg down. Is this going to cause the crash? I mean, the market's already down. I mean, the Nasdaq's down 27%. It was down 35% or so. It's pretty much crashed once already, but people are like, can it go down 50%? Because they look back at 2008 and 2001 and said, see, it can do that. When you go back to other recessions like 1990, it was a 20% correction. In fact, even when the Volcker years, the famous time when Paul Volcker was raising interest rates and slaying inflation, the market fell 27%. So it wasn't the big one, but 1974, it fell 50%. So we don't know whether it's a 50% sell-off, which is usually driven by something much worse, or something around 30%, which is roughly what's priced in right now. I'm erring to the 30%, so i.e. the risk reward is looking more attractive than if we were in 2008, where we had something much worse going on. And first time around 2013, it was significantly less because it was riskier. We didn't know, was this technology going to survive? Was it going to be banned? All of the questions that have now mainly been resolved, we didn't know that back then. It's like, here's a bet. I think I wrote the first ever macro strategy piece on Bitcoin in 2013. And I said, it was $200 at the time. I said, listen, if we value it like gold, it could be worth $1 million. So let's assume I'm an idiot and discount myself by 90%, still worth 100 grand. And therefore at $200 with the upside, you could lose all your money, but the upside was 100,000. I'm like, this is the best risk reward I've ever seen in my entire life, and the best one any of us will ever be given. And that actually proved out to be the case. I mean, they've just raised $60 billion in venture capital, and everybody's building out projects, whether it's lending markets, financial markets on DeFi, whether it's putting traditional financial markets onto blockchain rails, whether it's putting real estate onto blockchain, whether it's building, doing really interesting things with NFTs, such as ticketing. So we're seeing Ticketmaster has issued 10 million NFTs, the largest NFT issuer in the world. That's going on. We've seen Solana building a phone which integrates all Web3 in your wallets. You've seen, I mean, there's literally almost too much to keep on top of. So, how do you pass through all of that excessive information? You start looking, okay, what are the main chains that the activity takes place on? And the main place is Ethereum, and then places like Solana, Avalanche, Polkadot, and a few others. So that's how you kind of filter down. You see all of this stuff going on. You're like, oh, this is overwhelming. I think Mark Zuckerberg understood this, that the Facebook feed is out of date for where the world is going, that the world will be, because what are you doing on Facebook or Instagram or any of these things? You are basically communicating with friends and others around you and kind of dropping into their lives and all of this stuff. So why should that be in a 2D feed of stuff? Why should it not be in something more immersive where we could hang out together and do this interview in feeling like you're in a room together? And that's where we're going. It's just a matter of time, and everybody's building out for that vision. The most powerful thing that I ever created was a network. And I didn't really realize that. And my network started at Goldman Sachs and maybe before that. And then the people that came into my network along the way, if you give them good karma, you're good to people, you help people. What happens is it builds, like in crypto, this network that has value to you as a person and also to the other people. And so even in this digital world, having a network of people around you, don't have to be physical, that you help out and they help out you, you don't realize the opportunities that's going to bring. And you measure yourself by the quality of that network too.